And now shifting focus back to India. Now, India runs a trade deficit of $333 billion. It imports 88% of its crude oil every month. The country spends $19 billion just buying oil. The result, rupee hitting repeated record lows, testing 97 per dollar for the first time ever. Suggestions are for interest rate hikes. But rate increases to defend the rupee is not going to fix the problem. Every basis point of rate hike makes borrowing costlier for Indian businesses. It does nothing to cut the import bill. Punishing Indian growth to attract foreign bond money is also a bad trade. Compare this to China. Beijing held the yuan deliberately weak for 15 years. And that decision built an export machine that now runs $1 trillion annual surplus. India sits on the opposite end. It imports oil, gold, fertilizers, electronics and edible oil. Strengthening the rupee when half of your exports need imported raw materials just inflates the cost. It does not make you competitive. The Reserve Bank of India has burned through $30 billion in reserves since February, trying to shore up the rupee. That is not a strategy. That is running on a treadmill while the floor keeps moving. India has no structural dollar-earning engine that scales with rupee weakness, the way manufacturing does for export economies. Foreign portfolio investors have pulled out $21.73 billion from Indian stocks in just 4 months. Bond inflows alone cannot plug that gap. With Brent crude above $100, India's current account deficit is heading towards 2% of GDP. So raising rates to attract foreign debt capital while the domestic economy needs cheaper credit is like fixing a leak by drilling another hole in the same wall. The rupee problem is real, but rate hikes won't solve it.